Good morning and welcome to the Bulls, Bears, and the Bell morning edition of the Deep Dive. Thank you for joining us. Our mission today, well, it's simple but pretty critical. We're taking a really dense, high-stakes pre-open market intelligence briefing for today, Monday, October 21st, 2025. And we're going to carve out the essential knowledge that you need. We're unpacking the extreme caution gripping the major indices right now. We'll highlight the opportunities for some explosive kind of idiosyncratic gains in sectors like biotech and also chart the macroeconomic hazards defining this week.
Yeah, that's a perfect way to put it. We are definitely starting this week and really the broader fourth quarter in a state of, well, uneasy consolidation, I'd say. The major indices, they're effectively paralyzed, just kind of holding their breath. And the overarching theme, it's really driven by the calendar. Specifically, you've got two major events that demand this caution. First, there's the delayed September Consumer Price Index report, the CPI, that hits Friday. And second, the Q3 earnings season is pivoting right into the heart of the technology bellwethers. This week, honestly, we find out if that whole AI narrative is, fact or fiction.
Okay, let's unpack that central tension then, because like you said, the NASDAQ and the S&P 500, they seem to be hitting the pause button. It suggests this period of market consolidation. But if you look beneath the hood, specific stocks, especially in biotech, are seeing volatility that's just it's so extreme, they're generating triple-digit gains overnight. It feels like a very asymmetric environment, real study in market divergence. We need to dissect how this sort of macro calm contrasts with the micro chaos. All right, let's kick things off with a global picture. Where are the major indexes positioned as we get closer to the opening bell this morning? We're seeing U.S. index futures pointing to a modestly lower open. As of about 8:00 a.m. Eastern Time, S&P 500 futures are down just slightly, maybe. Minus 0.07%, and the NASDAQ 100 futures are pretty much mirroring that, also modestly lower at minus 0.09%.
Right, and this modest pullback, it's really critical context. It comes right after a very strong prior session. Remember, the Dow Jones Industrial Average closed up a huge 515 points, and both the S&P 500 and the NASDAQ Composite logged significant consecutive gains heading into the weekend. So when the source material characterizes this slight pre-market softness, they're calling it healthy consolidation and profit taking.
Okay, but let's maybe challenge that characterization just for a second. Some analysts might argue that after a big rally like we just saw, any softness, especially going into a high-stakes CPI week, well, couldn't that be a sign of exhaustion, maybe a bearish retreat to safety? Why are you so confident labeling this as just healthy consolidation and not, the start of something worse?
Well, I think it comes down to the magnitude and the timing. If this were a genuine bearish reversal, you'd expect to see futures down, say, 0.5% or more. And you'd probably see that accompanied by a noticeable spike in volatility, maybe a strong rotation into traditional defensive sectors like utilities or staples. Instead, the decline is really marginal, less than 0.1%. It suggests that investors who made good money last week are simply trimming a bit, taking some profits off the table, and maybe ensuring they have liquidity before they have to react to the big data releases later this week. It feels more like an act of prudence, not panic.
That distinction makes a lot of sense. But what about the internal divergence within the U.S. market itself? We mentioned NASDAQ 100 futures are slightly underperforming the Dow futures in the pre-market. The Dow often seems a bit more resilient. Doesn't that subtle underperformance in the tech-heavy index feel like a key signal? Maybe some apprehension there.
Oh, absolutely it is. And I think it speaks volumes about how investors are positioning themselves ahead of earnings season, really kicking into high gear. The NASDAQ 100, that represents your high growth, often high valuation tech companies. So when it shows even slight underperformance relative to the Dow, which, has more cyclical, industrial, or value names, it often signals a short-term rotation away from that higher risk. It suggests traders might be a bit nervous about committing heavily to those, let's face it, pretty lofty tech valuations just days before we hear from major players like Netflix, Tesla, and others. This kind of movement suggests caution, maybe specifically regarding that AI thesis we mentioned, and it acts as a sort of early warning sign that the market's positioning defensively, even within the equity space itself.
Okay, now let's look across the Atlantic, because the story unfolding in Europe seems like a real contrast. It's creating a pretty significant global divergence, right? The U.S. is cautious, pausing, but Europe seems to be flashing some positive momentum.
Yes, exactly. European futures are trading with modest gains, kind of continuing their positive runs. The FTSE 100 in the UK, it's trading higher, up about 0.18%, and it's hovering near record highs. It seems boosted by strong performance in defense and mining stocks over there. Similarly, the DAX in Germany is also slightly positive, up 0.16%, extending its really impressive run into record territory as well.
So why the split? If the U.S. market is holding its breath waiting for U.S. inflation data, why isn't the rest of the developed world, equally concerned?
Yeah, it's a good question. The why seems to reflect different regional positioning and maybe some unique catalysts over there. European markets are still enjoying the tailwinds from some positive regional corporate earnings. We saw good reports from heavyweights like L'Oreal and Unicredit recently. And crucially, they're also benefiting from broader global themes like maybe easing US-China trade tensions, which could disproportionately impact major European exporters. The U.S. market, having just digested strong domestic news and that rally fueled by maybe potential government shutdown resolutions, well, it's paused. Europe, you could argue, is simply catching up on its own region-specific bullish catalysts, and that's creating this temporary decoupling from U.S. domestic concerns.
That sets the stage perfectly for our technical learners, because when we talk about these moves, S&P 500 futures down 0.07%, we're actually talking about specific contracts. Let's maybe do a quick technical deep dive on these instruments themselves.
Yeah, definitely. This is a really crucial area for anyone who wants to understand modern market mechanics, especially outside regular trading hours. When we refer to U.S. index movements pre-market or post-market, we're monitoring futures contracts. Predominantly, these are the E-mini and the micro E-mini contracts traded on the CME, the Chicago Mercantile Exchange. These are standardized, very liquid financial instruments. They allow institutional investors, hedge funds, and increasingly retail traders to gain exposure to the index's direction without trading every single stock in it.
And the size difference between the standard E-mini and the micro E-mini, it's not just about cost, right? It's fundamentally about risk management and market accessibility.
Yeah.
That seems to have changed the whole trading landscape.
Absolutely. Take the main E-mini S&P 500 contract. The ticker is ES. It has a $50 per point multiplier, so even a small move in the index can lead to a significant profit or loss fluctuation. Historically, this meant that index futures exposure was largely the domain of, well-capitalized institutional players. However, the introduction of the micro E-mini S&P 500, the MES contract, with its much smaller $5 per point multiplier, well, that really revolutionized the market. It's a democratization of exposure. It means smaller accounts or individual retail traders can now effectively hedge their portfolios, manage risk during highly volatile periods, or simply speculate on index direction without the, frankly, prohibitive capital requirement of the full E-mini contract.
So when we see high volatility like the kind we're sort of expecting this week with CPI and earnings, these micro contracts become really indispensable tools, don't they?
Precisely. In weeks defined by these big binary high-stakes events like CPI, large traders who might normally hedge with a full ES contract can scale down their hedge using multiple MES contracts. It allows for incredibly granular risk management. It means traders can react almost instantly to that 8:30 a.m. CPI data release, managing their exposure without having to wait for the cash market open at 9:30 a.m. And this structure, it's replicated across the major indices. You have NQ for the NASDAQ 100 and MNQ for the micro NASDAQ, NYM for the Dow, MYM for the micro Dow. The availability of these smaller instruments, I think it contributes to overall market stability and liquidity, even when the underlying sentiment is cautious, like it is now.
Okay, let's talk more about that caution now. We have indices consolidating, sort of bracing themselves for a packed week. But here's what feels like the central paradox. Despite this high-stakes calendar, you've got CPI data on Friday, major tech earnings all week long, the CBOE Volatility Index, the VIX. It's remarkably subdued. It actually declined in the previous session. What is this VIX enigma telling us about market expectations right now?
Yeah, the VIX, often called the market's fear gauge, is essentially the market's collective forecast of expected volatility over the next 30 days. A low VIX, especially in this kind of context, suggests, well, some might call it extreme complacency. The market's base case right now is clearly a sort of Goldilocks scenario. They seem to expect inline or maybe even cooler inflation data, and they seem to expect broadly positive, confidence-boosting earnings reports from those tech heavyweights. The market right now, it feels like it's priced for relative perfection, or at least priced for smooth sailing ahead.
But hang on, when you have a calendar loaded with critical binary data points, data points that are historically known to cause massive swings that low VIX, feels less like confidence and maybe more like, willful blindness.
That's the critical insight, exactly. It creates a risk profile that we often call asymmetric risk, because the current VIX level shows the market hasn't really bothered to price in or hedge against adverse outcomes. So any negative surprise, and I mean any significant negative surprise, whether it's CPI or a big earnings miss, could lead to a disproportionately large and sudden spike in volatility.
Right. So if that CPI number comes in even just slightly hotter than expected, the VIX doesn't just sort of nudge up. It could potentially explode higher, causing maybe an outsized drop in equities. Is that the idea?
That's exactly the idea. Imagine the expected range of movement for the S&P 500 over the next month is quite tight because the VIX is low. That's what low VIX implies. If the data comes in within that expected range, maybe the market moves marginally higher, maybe drifts a bit, business as usual. But if the data falls outside that range, let's say inflation really surprises to the upside, the mechanical reaction gets magnified because there aren't enough hedges in place protecting capital. Those who are short volatility or maybe just long equities without protection, they suddenly have to scramble to cover their risk. That action itself drives prices down sharply and forces the VIX to rapidly catch up to the new reality of the situation. So the risk is asymmetric. The potential reward if things go right seems modest based on current pricing, but the potential penalty if things go wrong could be quite severe.
So we're essentially saying that the very calmness of the VIX reflecting this market complacency is actually one of the single biggest risk factors this week, because it reflects a maybe false sense of security regarding CPI and earnings. It's kind of like the market equivalent of sailing directly into a potential hurricane while the surface of the water still looks glassy calm.
That analogy is spot on, I think. And this apparent lack of macro hedging creates a really interesting contrast when we look at the individual stock movements. While the major indices seem complacent, reflecting in that low VIX, that complacency does not translate down to the micro level. That's where we see the true chaos, the wild swings. The market seems very good at ignoring broad macro risks until they become immediately visible, but it absolutely cannot ignore individual, binary, company-specific risk.
That transition is perfect. Because while the broad market is holding its breath, today's pre-market session is really defined by an incredible split. You've got these hyper-specific binary events driving extreme volatility in certain pockets, like biotech, contracted really sharply with some harsh profit-taking in those high momentum stocks that ran up recently. Hashtag tag, IZO, biotech bonanza, triple-digit gains. Yeah, biotech has always been a bit of a binary world. It's either a huge success or a total bust. But today looks extraordinary, even for that sector. We're seeing triple-digit percentage gains across the board. Leading the charge is Rani Therapeutics, RANI, surging an almost unbelievable plus 248% in the pre-market. This isn't just a positive day. This feels like a fundamental revaluation of the company.
It really does seem like a game changer for the company, and it's driven by a powerful 1-2 punch that drastically seems to de-risk the investment profile for them. First, they announced an oversubscribed $60.3 million private placement. Now, normally, shareholder dilution from a placement might hurt the stock price, but here it seems viewed as a necessary positive. Why? Because that money, coupled with the second piece of news, a major collaboration with Chugai Pharmaceutical, potentially worth up to a whopping $1.085 billion, secures their future.
Okay, $1 billion collaboration is obviously the big headline grabber, but what's the strategic significance there for the long-term investor looking at RNA?
Well, the financing itself extends the company's operational runway, their cash runway, out into 2028. For a biotech company that's typically burning cash while waiting for drug development milestones, extending that runway by years is a massive relief. It removes the immediate pressure for potentially more dilutive financing down the road. And what's crucial here is the market's reaction. Investors are overwhelmingly prioritizing that long-term strategic value, the billion-dollar validation from a major player like Chugai, and that extended cash runway over the immediate dilution caused by the private placement. This kind of move signifies intense institutional and probably retail enthusiasm about their underlying technology platform.
Okay, next up we have Arteva Biotherapeutics, RTV, also rallying dramatically, up plus 117% roughly? Their catalyst seems purely regulatory, the FDA.
That's right. ARTV's surge is a direct reaction to the FDA granting fast-track designation for its lead candidate, Alemcrea, which is being developed for refractory rheumatoid arthritis. Now, this isn't just a procedural pat on the back, it's a significant strategic validation from the agency. Fast-track status signals and potentially expedited path to market. It means the FDA recognizes the drug's potential to address a serious unmet medical need and will likely dedicate more resources to speed up its review process. For investors, this potentially reduces the time and the regulatory risk involved, dramatically shortening the timeline before potential revenue generation could even begin. And the release mentioned the drug has the potential to be the first in its specific class to advance to a pivotal trial in UNRA, which could cement a valuable first-mover advantage if successful.
And rounding out these top gainers, we see Celcuity, CELC, soaring to record highs. This one's based on clinical trial results, specifically for a breast cancer drug, right?
Yes, CELC announced what some reports are already calling potentially practice-changing Phase 3 clinical trial results for its drug, gedatolisib. The initial report suggests this drug is highly efficacious and could directly challenge some of the established multi-billion-dollar treatments currently used in the oncology space. Oncology is, of course, one of the largest pharmaceutical markets globally. So the potential for this kind of market share disruption where a new drug could genuinely redefine the standard of care, that's exactly what seems to be getting priced in right now. The stock is trading well above most prior analyst fair value estimates, which tells you the market is pricing in a scenario of rapid commercial success and significant future profits. Hashtag B, the correction in high growth. Losers.
All right, now let's flip to the other side of the ledger, where profit-taking and maybe valuation realities are hitting pretty hard. Leading the losses today is Obook Holdings, OWLS, down over 27% in the pre-market. This looks like the poster child for an immediate reality check after a huge run, doesn't it?
It really is the epitome of the sell the narrative story, followed by an immediate sharp mean reversion. Mean reversion for listeners is just that market principle that assets, after a really dramatic move up or down, tend to eventually gravitate back toward their long-term average valuation or price. OWLS had its direct listing debut just a few days ago, I think October 17th, and it surged over 450% almost purely on the narrative of being Asia's first fintech company to achieve a direct listing on NASDAQ.
Right, 450% in just a few days. That screams speculation, not really fundamental investing.
Precisely. That massive surge was almost entirely narrative-driven hype. Now the market seems to be demanding the financial reality check. Reports suggest OWLS suffers from, quote, weak fundamentals, including things like a poor financial health score and negative EBITDA, meaning it's not profitable on an operating basis. That kind of sharp run without strong fundamental backing often leads to these violent corrections as soon as momentum shifts or the narrative fades. The initial euphoria is clearly gone. And traders are now facing the reality that the company likely needs years of significant growth just to justify even a fraction of that peak valuation hit last week.
And we see somewhat similar, though maybe more complex, action in the quantum computing space with D-Wave Quantum, QBTS, down over 10%. This drop isn't just simple profit-taking. It seems to involve a specific technical trigger, warrant redemption. Can you unpack that?
That's right. QBTS had an absolutely staggering 3,200% run-up over the past year or so, fueled almost entirely by the future promise of quantum computing, a very long-term narrative. The current drop looks like a confluence of factors hitting at once. There was an analyst downgrade citing extreme valuation concerns, which isn't surprising after a 3,200% run. And then there's that crucial technical action. The company announced it's redeeming all its outstanding public warrants. For those unfamiliar, a warrant basically gives the holder the right, but not the obligation, to buy the company's stock at a fixed price, the strike price, at some point in the future. When a company forces the redemption of these warrants, they essentially force the warrant holders to make an immediate decision. Either exercise the warrant, meaning buy the share at the strike price, or sell the warrant itself before it expires worthless.
Okay, and why does forcing that decision typically lead to selling pressure on the stock itself?
Because many warrant holders, especially after a massive 3,200% run-up in the underlying stock, are likely holding warrants with a strike price far below the current market price. So they'll often exercise the warrant, acquire the stock at that significant discount, and then immediately sell those newly acquired shares into the open market to lock in their immense profit. This influx of new shares hitting the market quickly increases the available supply, which can overwhelm existing demand and thus creates significant selling pressure on the stock price. It's a pretty classic technical driver for that mean reversion we talked about, especially after such a parabolic narrative-driven rally that maybe got ahead of fundamentals.
And finally, let's just quickly touch on Exelixis XEL, which is lower due to a classic sell the news reaction, down about 12%. The report said the top-line results for their trial were met, so what detail might have caused this negative reaction?
Yeah, in drug trials, especially complex ones like oncology treatments, the devil is always in the details. XEL shared more detailed results from its Stellar 303 Phase 3 trial. And while, yes, they met the top-line endpoints, meaning the drug performs statistically better than the control arm, the negative reaction strongly suggests the market found some of the nuanced details perhaps underwhelming. This could be anything from a less favorable side effect profile than maybe analysts had hoped for, or perhaps the magnitude of the clinical benefit, while statistically significant, wasn't substantial enough to really differentiate it aggressively from existing, well-established treatments. The market can be quick to punish perceived incrementalism when it was hoping for revolutionary results, and that seems to be what led to the sharp, immediate sell-off on the detailed news release.
Okay, let's zoom out now from those really specific micro movements back to the broader macroeconomic landscape. Because that pause we're seeing in the indices, it's intrinsically linked to the very densely packed calendar this week. This is really shaping up to be a week defined by key economic data releases.
Absolutely. The primary focus is definitely on inflation, but the whole calendar is busy. Midweek, we get our regular checks on the labor market. Continuing and initial jobless claims on, I believe, Wednesday. Along with that, we get September existing home sales data, which gives us some insight into how the housing market is reacting to these higher interest rates. Then later in the week, I think Thursday, we get the S&P Global Composite PMI flash. That's a timely read on business activity and also new home sales data for September.
But the main event, the one that's really been hanging over the market, is that delayed September Consumer Price Index report that finally drops on Friday morning at 8:30 a.m. Eastern Time.
Yes, this September CPI report is, without doubt, the single most critical data point of the entire week. It could really dictate the market's trajectory heading into November. Let's look quickly at the consensus forecasts. The market is generally expecting the headline inflation rate, year over year, to tick up just slightly to 3.1%. That's up from the previous reading of 2.9% in August. However, the core inflation rate, year over year, that's the one that excludes volatile food and energy prices, and the one the Fed watches more closely, is expected to remain steady at 3.1%, same as the previous month.
Right, and since the Federal Reserve has stressed repeatedly, almost ad nauseum, that it is data-dependent, this report is the true test of their current policy stance, isn't it? What are the specific stakes here for the Fed and for the market's whole rate cut thesis that's been building?
The stakes are just enormous. The market has rallied quite significantly over the last several weeks, pricing in fairly aggressive anticipation of impending rate cuts, perhaps starting in early 2026. Now, this entire rally is based on the core assumption that the disinflation trend, which started earlier this year, is still firmly intact and heading towards the Fed's 2% target. This CPI report either validates that core assumption or it completely invalidates it.
Okay, let's define the scenarios really clearly then. What's the bullish scenario if CPI comes in around expectations, or maybe even cooler?
The bullish scenario involves an inline reading, so around that 3.1% core, or ideally a cooler than expected reading. This would reinforce the disinflation narrative. It gives the Federal Reserve more breathing room, maybe takes pressure off them, and it essentially grants the market the green light to maintain or even increase its current expectation of future rate cuts. That kind of certainty or validation would likely unleash a pretty significant relief rally in equities, especially in those rate-sensitive technology and growth stocks that have benefited so much from falling yield expectations.
Okay. Conversely, if the CPI number comes in hotter than expected, the bearish scenario could trigger almost instantly, right?
Instantly, yeah. A hotter than expected number, anything significantly above that 3.1% core expectation, or maybe showing sticky components, would immediately reignite inflation fears. It would force the market to significantly push back those rate cut expectations, perhaps into late 2026, maybe even further out. It might even prompt renewed, albeit currently unlikely, talk of another potential hike. But the immediate impact would be on risk assets. They would likely suffer massive pressure due to the resultant spike we'd almost certainly see in Treasury yields. And given that asymmetric risk profile we discussed earlier with the low VIX, this is the kind of trigger that could send the VIX spiking violently higher.
And when we analyze the CPI, it's important to remember it's not just about the single headline or core number, right? The Fed pays really close attention to specific components, and some of those have been proving much stickier than others.
Absolutely. That's a critical point. The Fed isn't overly concerned with month-to-month swings in, say, volatile energy prices. They tend to focus much more on core services inflation, and particularly core services excluding shelter. And that shelter component, driven largely by housing costs and rents, has proven incredibly sticky, lagging behind other components on the way down. So we really need to look beyond just the headline number and scrutinize the details, especially the shelter component and maybe wage-sensitive service prices. If services, and particularly shelter, remain stubbornly high, it signals that the inflationary pressure might be more deeply embedded in the economy and potentially harder for the Fed's traditional interest rate tools to control quickly. If sticky shelter is the main driver keeping that core number elevated around 3.1%, it complicates the Fed's job immensely, regardless of what the headline number or even the labor market might be showing.
Okay. And beyond just the U.S. domestic concerns, we should also remember that global economic influences are heavily impacting other asset classes too, particularly currencies and commodities this week.
That's definitely important context. This week also brings central bank meetings or statements from several key international players. We've got the Bank of Japan, the Reserve Bank of Australia, and Bank of England all potentially making news. And their decisions and commentary heavily drive the forex markets and influence global liquidity flows. For example, we just saw the UK report its September inflation rate, which will directly impact the Bank of England's stance and the pound sterling. What's also highly notable, I think, is gold's current position. Gold prices are holding near record highs. This seems driven partly by its classic safe haven appeal amid that lingering context of the U.S. government shutdown uncertainty, but perhaps more fundamentally by those market expectations of future Fed rate cuts. Rate cuts tend to weaken the dollar, making non-yielding gold relatively more attractive.
All right, let's shift gears now, moving from the big macro threat of CPI to the micro test of Q3 earnings season. The spotlight here is shifting almost entirely to the technology heavyweights. The performance of the S&P 500 this year has been so heavily influenced, almost singularly influenced by some measures, by the artificial intelligence narrative. People have even labeled the S&P 500 an AI index. So this week feels like the moment where we find out if that promise is actually meeting the profit reality.
This really is the definitive test of the year, I think. Investors have poured money into these names based on a futuristic premise, the idea that widespread AI adoption will translate into unprecedented efficiency gains, new revenue streams, and expanding margins. The valuations of those so-called Magnificent Seven stocks, and by extension the broader market, rely heavily on this AI promise holding true. So this earnings season, starting now, is the moment they absolutely must deliver tangible, verifiable evidence that this narrative is already translating into current performance improvements, not just saying some far-off future aspiration. #tag AAQ reports to watch.
Okay, the first major tech bellwether up is Netflix, NFLX. They report Tuesday after the market close. Netflix has navigated some major strategic shifts recently, right? The crackdown on password sharing, introducing that ad-supported tier.
Exactly. And analysts are looking for pretty robust numbers based on those shifts. The consensus estimates seem to peg earnings per share around $6.94, which would be a strong 28.5% increase year over year. And revenue is expected around $11.51 billion. But as you alluded to, the headline numbers themselves might actually be secondary this quarter to the strategic updates and forward guidance.
So what specifically will investors and analysts be scrutinizing most closely on the Netflix earnings call?
I think the focus will be intensely on the health and the growth metrics of that advertising tier. This ad-supported model is really anticipated to be a primary revenue driver for them heading into 2026. It fundamentally alters the company's long-term business model away from pure subscription, so they need to show it's working and scaling. Investors will also look for granular data on subscriber trends, particularly in key international markets where growth potential is high. And, crucially, any commentary on content spending will be key. The market wants proof that Netflix can effectively control its massive content budget while still continuing to grow its subscriber base through these new monetization strategies like ads. Any hint of weakness in that ad tier adoption, or maybe slowing subscriber growth despite the password crackdown, could prompt a significant sell-off.
Okay, and then on Wednesday after the close, we get the big one, Tesla, TSLA. This feels less like a pure AI test, maybe, and more like a massive barometer for the entire electric vehicle sector, and maybe even autonomous driving hopes.
It's a colossal test, absolutely. Tesla's results will provide a really critical indicator of the health of the EV giant itself, especially amidst rapidly increasing global competition, particularly from Chinese manufacturers like BYD, and some persistent questions about overall demand in various worldwide markets. Unlike maybe previous quarters where production numbers were the main focus, the market now seems fixated on profitability metrics, especially gross margins, given the price wars Tesla initiated earlier this year. Furthermore, any updates on their autonomous driving division specifically, actual proof of AI progress translating into tangible product advancements like FSD improvements will be absolutely paramount for justifying its high valuation. If Tesla shows unexpected cracks in its margins or expresses significant caution on global delivery figures for Q4 or next year, the negative ripple effects could depress valuations across the entire high-growth, high-multiple tech sector.
And we also have a whole host of other critical industrial and technology reports sprinkled throughout the rest of the week, just adding to the nervous energy, right?
Right. It's a busy earnings week beyond just those two. We start today Monday, after the close with Texas Instruments, a key semiconductor player for industrial and auto markets. Then Tuesday, after the close, besides Netflix, we also get IBM, which is a major player in corporate AI solutions and cloud computing. Wednesday after the close is Tesla, but then Thursday after the close brings Intel, another semiconductor giant whose fortunes are directly tied to the massive infrastructure build-out required for AI, along with Ford Motor, giving another read on the auto sector. And rounding out the week on Friday morning before the market opens, we get the consumer staple giant Procter & Gamble, which provides important insight into the overall health and spending patterns of the global consumer. Hashtag #HIB, the critical AI validation test.
Okay, let's just hone in again on that core concept, the AI validation test. We've had months, maybe even over a year, of this narrative driving stock prices significantly higher. What are analysts specifically looking for now to confirm that the AI promise is real and actually justifies these current valuations? It really can't just be happy talk from CEOs anymore, can it?
No, it absolutely cannot be just happy talk. They are looking for tangible, quantifiable evidence. It is no longer enough for a CEO to just say, we are investing heavily in AI and it's the future.
Yeah.
Companies, especially the chip manufacturers like NVIDIA or AMD and the big cloud platform providers like Microsoft Azure, Google Cloud, Amazon AWS, they need to show precisely how that AI investment translates into specific measurable financial metrics now, or at least in their immediate forward guidance.
Okay, so what are those specific metrics? How do you actually prove AI revenue or AI impact?
Analysts are likely combing through three main areas in the reports and calls. First is capital expenditure, CapEx. Are these companies spending truly massive amounts on the necessary infrastructure, things like data centers, advanced AI chips from NVIDIA, networking equipment? If they aren't showing significant CapEx growth allocated to AI, arguably they aren't truly building that AI future they talk about. Second is margin performance. Is the introduction of new AI features, tools, or services actually leading to higher profitability? AI is supposed to drive significant efficiencies and potentially command premium pricing. So if operating margins are flat or worse, falling, it suggests the AI investment isn't paying off financially yet, or maybe the costs are outweighing the benefits initially. And third, and perhaps most importantly, is specific product line growth. Companies need to start attributing quantifiable revenue growth directly to AI-specific services, platforms, or hardware sales. For instance, in cloud computing, analysts want to see specific growth figures reported for advanced AI as a service, AIaaS platforms, or dedicated AI hardware instances, not just overall cloud growth.
Right. So if these tech leaders fail to deliver on this pretty high bar, if the numbers, the margins, the CapEx, the guidance simply don't match the market's built-up enthusiasm, the downside risk could be massive, couldn't it?
The downside risk could be catastrophic for some names, potentially, because the market has been incredibly forgiving of lofty valuations based almost entirely on this futuristic AI premise for well over a year now. A failure to deliver on that AI promise may be evidenced by missed margin expectations blamed on AI costs, or weak forward guidance on AI-related CapEx or revenue adoption could lead to a dramatic and quite painful repricing of these market leaders. And this wouldn't just impact a single stock, because the S&P 500 itself has become so concentrated in these few massive AI-centric names. A major disappointment from one or two of them could realistically drag the entire broader index down significantly. This is exactly why this particular earnings season right now feels like such a high-stakes crucible for the entire market narrative.
Okay, so if we try to synthesize everything we've looked at today, from the consolidating index futures and those hyper-specific explosive biotech gains on the one hand, to the looming threat of the CPI report and this really mandatory AI validation test from earnings on the other hand, it seems pretty clear the market is balanced on a razor's edge right now.
That tension is just undeniable. You can almost feel it. We can probably summarize the powerful opposing forces driving the market this week pretty simply. On the bullish side, you've still got reasonably strong existing Q3 earnings momentum from the early reporters, especially financials. There's maybe some growing optimism regarding global trade tensions easing slightly, providing a geopolitical tailwind. You also have the sustained hope for a timely end to the ongoing U.S. government shutdown situation, which removes an uncertainty. And fundamentally, there's still that powerful underlying AI narrative that continues to attract massive capital inflows.
But countering all that optimism, the bearish forces look pretty substantial too. You've got the looming threat of a hot CPI report that could instantly derail the whole Fed rate cut thesis. That's coupled with arguably stretched, maybe even speculative valuations in many of those market-leading technology stocks. And there's the ever-present potential for earnings disappointments from key bellwethers that could trigger a much wider market correction.
Yeah. So For the immediate path, just looking at today, trading is likely going to be somewhat range-bound and probably highly headline-driven if any unexpected news pops up. Participants will likely be extremely hesitant to commit to large new directional positions ahead of the main events. They are essentially waiting for the data releases later in the week to provide more clarity. The market seems to have clearly identified its two major inflection points for this week: that Netflix report after the bell on Tuesday, and then the crucial CPI data release on Friday morning. Everything else feels like noise until then.
What really stands out looking at all the source material we reviewed is that the entire market just seems to be in a show-me state right now. The high-level optimism, that whole AI narrative, it needs immediate, tangible validation from hard numbers, from earnings, from guidance, and from that CPI print.
And I think this brings us back to the key strategic takeaway for you, the learner, as you try to navigate all this information this week. Given the notably subdued VIX and the fact that the market appears clearly priced for near perfection, expecting inline CPI, stellar earnings, the biggest challenge the next few days, probably isn't reacting to what the market expects to happen. The real challenge is recognizing and perhaps preparing for the unexpected outcome.
Right. Focus on that concept we discussed, asymmetric risk. Because when the market is this outwardly calm and complacent, reflected in that low VIX ahead of this much potentially definitive data, the potential opportunity, or maybe the sudden penalty, for a surprise, whether it's an upside surprise or a downside one, is absolutely magnified. The strategic question for every investor this week really must be, how much dry powder do I have? And how prepared is my portfolio for the outcome that maybe no one is currently hedging against? That underlying sense of heightened, potentially hidden risk beneath the calm surface. That's what truly defines this trading week, I think.